I'm about to break down a crucial investment choice. Cash in hand or bigger slices? Dividends pay you today while buybacks pump up your stake tomorrow. Both signal confidence, but which strategy boosts your wealth faster? Watch the full video to discover the smarter way to ride corporate profits.
To wrap up the fusion issue, Gary, the fifth thing, educational topic here. We're talking about how companies return capital to their investors. We're going to talk about dividends and buybacks, Gary, but why don't we just start with a high-level overview of how companies return capital to their investors, Gary?
All right, Rob. So obviously, when we invest in a company, we want to receive more money later, right? If you invest $100 today, we want more than that a year from now, or 5 years from now, or 10 years from now, whatever your investment time horizon is. There are basically three ways, there are dozens of ways, but there are three main ways that companies return capital to shareholders. One would be to take cash flow or earnings from company operations and invest them in more company operations, right? This is something that Amazon did for decades, right? Instead of giving the money they made or didn't make rather to shareholders, they built a bigger and bigger business. They built Amazon Web Services. They built out Amazon Prime Video. They built out more warehouses. They just made it a bigger, better business. Okay, and the company became much more valuable. Good for them. Two other ways they can do that are returning capital to shareholders, either through dividends. A dividend is where the company actually writes you a check as a shareholder. Check your brokerage statement and you'll see that, dividend from company XYZ got paid and there'll be more money in your account. You have cash. Great. And then the third way is something called the stock buyback, where what the company will do is they'll take that same money and they'll go into the open market, right? Just like you or I could go into the market and buy stock in any company today. They buy their own shares back and retire them. And the retiring them is the key thing. So I want you to imagine a scenario where, let's use a ridiculous example, a company with 10 shares outstanding, Rob. So you own one share, I own one share, and 8 other people each own one share. The company says, well, we've got some extra cash flow. We're going to buy back one share. And they go to, one of the other guys who owns it, and they buy that share and they retire it. Now, the company is out cash, but Rob, you and I, before we owned 1 out of 10 shares. Now we own 1 out of 9 shares. Our percentage ownership in the company is increased by roughly 10%, right? Because 10% of the shares outstanding have now disappeared. They're gone forever. When people talk about a stock buyback being a one-time benefit, that is not correct. Those are people who do not understand the way this works. Those shares are retired. So, those are the three main ways. And the reason we're only today talking about dividends and stock buybacks is because a company that invests in its own operations trying to increase the value of the company, well, that one's kind of obvious and everybody understands that.
Gary, do you have any particular preference one way or the other, dividends, buybacks? Do you look for stocks particularly one way or the other? I know specific stocks paying out dividends. Pros, cons for you, or preference one way or the other?
I do, yeah. And not everybody's going to agree with me on this. I strongly prefer buybacks. So let's talk about why. And better yet, let's be fair on this. Let's talk about the advantages of dividends first, right? So with a dividend, you get a cash payment. That's great. And it's a recurring, predictable payment. Companies can change their dividends at any time, but generally what they do is they try to pay a consistent dividend. So imagine you have a company that says, okay, we are going to pay a dividend of 25 cents per share, typically per quarter, right? And what you'll see is that they get to the next quarter and that dividend will almost always then the next quarter be 25 cents and then 25 cents. And when they increase it and they try to increase it, obviously there are situations where they lower it. They'll try to increase slowly over time. So the next year you may get 26 or 27 cents per quarter per share. And what that does is it makes your payments more predictable. The other advantage of dividends is there are a lot of mutual funds and ETFs where the managers are only allowed to own companies that pay dividends. So simply by paying any dividend, even if it's just 1 penny per share, what it does is it opens up your stock to a whole other class of potential shareholders, and it allows more people to buy your stock, which can increase your stock price. So those are good things about dividends. I'll tell you the reason I like buybacks. Um, One is, and the key thing here is I'm assuming these are buybacks of a company where I like the stock price. The advantage of buybacks is it lets you determine the timing of realizing those gains. So let's go back to the hypothetical example we had just a few minutes ago, Rob, where we each own one share of a company. And because the company buys a share and retires it, our percentage ownership goes up by 10%. Um, that should make the price of our stock go up. And what we can do is we can realize that by selling our stock, or we can wait and realize it later. And the advantage of realizing it later is we get to pick our tax timing. So, for example, if we wait more than a year, we go from short term to long term capital gains, which tend to be much lower. And you also, if you wanted, could pick your timing for a situation where, maybe you have some tax losses in a given year. And so you could realize those gains and offset those tax losses and maybe not pay taxes on it. Now, for clarity, I am not a CPA. I am not a tax advisor. We are not giving tax advice. We're not qualified to give tax advice. This is a general way of understanding various things of how the stock market works. If you want tax advice, you should go seek the help of a qualified tax professional. I am not that person. I'm not qualified for that. Really just trying to give you a little background here. Now, the danger of buybacks is companies can harm themselves in two ways doing it. One, sometimes companies will buy back their shares when their stock is expensive, right? It may be at a level where I wouldn't buy it back. If they're buying their own stock back at a price that is more than the intrinsic value of the company, they're going to destroy value, and that's not a good thing. The other thing is there have been situations where companies have taken on debt and used that money to buy back stock. And so they're adding leverage. Now, if company operations go well and the stock market's strong, it's a great move. It can work extremely well. But you're leveraging up the balance sheet. You're taking on fixed liabilities, fixed payments to pay off that debt and reducing that cash flow. And you may end up having to do a secondary offering to save yourself at a lower stock price. Basically, when used well, buybacks are the best option, but they are more risky with management teams who at times have not used them wisely or taken on too much debt or paid too high a price for their stock. So it is more risky, but if it's a company that I like at a price that I like with a management team I trust, that's where you get, I think, the better return. And it gives you control of the kind of tax treatment you get. So that's why I prefer one. But for those of you who love dividends, great. We're not against you. I think dividends are terrific as well. I own actually a couple of pipeline MLPs, that stands for Master Limited Partnerships, simply because the dividend yield on these companies is like 7 or 8%. The dividend regularly grows. That's actually pretty good, right? To make 8% on your money and own a stock that's going up and a dividend that rises, I would rather own that than treasuries.